We're news for business people.
Hello and welcome to Bloomberg Quint Live. You're watching Trend Spotting. I'm Navneet Saluja D'Souza.
And I'm Nate, I'm Agam Akil. And then in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and implications for investors. And first, the headlines. It's muted trade on the first day of 2018. Broader markets outperform. India Wix advances further. And the country's largest car maker, Maruti Suzuki, reports a 10% rise in December sales, but exports drop 6% in December. And HDFC Standard Life gains more than 3% after CLSA initiates coverage. And it's a foggy start to 2018 in the national capital, affecting train and flight movement to and from the city.
Well, and it's a flat start for our markets on day one of this new year. But let's take a look as to what's exactly happening in the markets right now. Nifty and Sensex not doing too much today, just about a flattish day amid thin volumes that one has to see. Nifty is just about at 10,530. Sensex trading with gains of about 14 to 15 points. Bank Nifty has been able to sustain above those green marks today. In fact, it has been underperforming the Nifty, but let's see whether it's able to support that mark of 25,500, which everyone's been watching out keenly. In terms of sectoral indices, what's doing well right from the word go is the Nifty Realty Index. That's up almost over 2%. So you've got stocks like Unitech, Phoenix, Godrej Properties, HDI, you name it. And all these realty stocks have been doing pretty well. Besides this, the pharma pack is gaining strength right from last week. So the Nifty Pharma Index is also doing well. It's trading with gains of almost 1%. Just the IT pack has been trading weekend right from the word go. So the Nifty IT is down almost 0.5%, and the PSU banking space has seen gains of almost 0.5% so far. As Agam highlighted in the headlines, the volatility has been on the higher side. So the India Wix on day one of this new calendar year is trading with gains of 6.5%, and it has crossed its crucial mark of 12.5, which majority of the analysts actually track. Let's pull up the contributors list of Nifty constituents and see which are the stocks which are supporting the markets today. Your heavyweight ITC and HDFC Bank are trading in the green, and your top gainer on Nifty is Indiabulls Housing Finance, so that too is doing well. Sun Pharma continues to do well in today's session as well. What's capping the moves on the upside are stocks like TCS, HDFC, ICICI Bank and HUL. All these are your heavyweights in the index, but the broader markets, Agam, once again are outperforming. The Nifty small cap index is trading with gains of over 1%.
That's right, Navneet. This is a continuation of trend what we've seen over the past couple of days as well. But there are a few stocks that I do want to bring focus to, and one of them is Unitech, which is gaining 18% in today's day of trade. And it's not just Unitech. Along with Unitech, you also have DB Realty, which is also advancing. So both these companies have been on a reasonable rise. In fact, DB Realty is locked in another circuit, upper circuit of 10% after what we saw Friday as well. Himachal Futuristics has once again advanced in today's day of trade. We are looking at gains there as well, and this time on heavy volumes as well. So Himachal Futuristics is looking at a 14% up move. MTNL, of course, building on the kind of gains that we've seen last week. Again, we have seen a lot of activity return to MTNL. Today it's up another 11%, and along with that we have Jacob. Infibeam looking at some amount of recovery after the weakness that we saw last Friday. It's up 7% as well. Among the weaker counters, we have JP Associates, Jayaprakash Power Ventures, Vesuvius, and Reliance Communications are looking at a little bit of profit taking. But on the whole, again, it is yet another day where advances have taken over declines in the lead.
So that's a positive sign, as market breadth is looking good, and it remains to be a stock-specific market. All right, then on Trend Spotting today, we discuss the growth drivers for Titagarh Wagons as we connect with the Vice Chairman and Managing Director, Umesh Chowdhary. Is a revival in rural demand likely? We ask Anand Mour of ICICI Securities. And what is in store for players in the auto ancillary space? We ask Jinesh Gandhi of Motilal Oswal Institutional Equities. On to our first trend of the day. Titagarh Wagons has clocked in almost 42% gains in the last 3 months and is currently trading with gains of almost 2 to 3%. Edelweiss expects the upcoming Indian Railways order for 9,500 wagons to be a key positive for the company. Let's discuss this in further details with the Vice Chairman and Managing Director Umesh Chowdhary. Mr. Chowdhary, good morning to you and thanks a lot for joining us today on Bloomberg Quinn. My first question is, the wagon business has been muted in the recent past. Are you seeing any sort of pickup in demand for wagons?
Definitely, we've seen a definite pickup in demand for the wagon business. Railways as well as the private wagon demand has already started picking up. We've started receiving orders. So we can see a very tangible kind of turnaround in the offtake of wagons.
Have you received any communication that the new railway tender has been scrapped?
No, I believe that news article was more, I don't think it was substantive. I don't think that article was correct.
All right, then let's talk about the new orders. How much order are you expecting from Indian Railways out of the tender of 9,500 wagons?
So between us and our subsidiary, we should have close to about 24-25% of the market share.
Okay, and is there a pickup in the private sector demand for wagons, Mr. Chowdhary?
Absolutely. A lot of pickup has happened from the private sector, and we are seeing a very healthy growth in the private investments in the wagon industry.
Mr. Chowdhary, if you could tell us what's the total order book looking like for Titagarh currently, and what's the execution timeline that you guys are targeting?
The last announced order book that we had announced along with our September results on a consolidated basis, if I remember correctly, was about 1,500 crores, something about that. This is with a staggered delivery over a period of time, so different contracts have different deliveries, but I would say on an average one can consider at about 12 to 14 months.
And what opportunities are you seeing in the upcoming metro projects across Tier 1 and Tier 2 cities?
That is the big opportunity that we are targeting, and that's the reason why we had acquired our Italian subsidiary, because that gives us the technology access and the credentials to participate in the metro tenders. And for us, that is the big turnaround point, or the big business opportunity that we see over the next several years, I would say 3-4 years.
You mentioned about the metro tenders. Can you give any guidance or any number on total size of the metro projects?
Considering the projects that have been announced, the projects that have been on the pipeline, etc., the total metro demand in India could run as much, some reports suggest that they could run as much as 4,000 to 5,000 coaches over the next few years. Considering an average price of 10 crores a coach, it's a 50,000 crore market.
All right, and finally, Mr. Chowdhary, if you could give us expectations on the upcoming combined railway finance budget.
So there would be no railway budget separately, and which I believe is a very good thing that has happened, because the railways are not waiting for that one magical day of the year to really make the changes or to make the policy announcements or implement them also. What we have seen in the last in the present government is that the government and particularly the railways have been very proactive in amending their policies or introduction of new policies as and when the market demands so. So, I would say that the railways have really gone for a paradigm shift in the way they operate, in the way they function. And I can clearly see that they can, the railways turning around and coming out of the financial problems that they were in the past.
All right, Mr. Chowdhary, we leave it at that note. Thanks a lot for joining us today and giving us a sense as to what one can expect with regard to new orders that could come up and also with regard to the metro project. That was the management of Titagarh Wagons. The stock's been trading in the positive territory in today's session. In fact, for the last calendar year, it gave you returns of almost 35%, but maximum returns, Agam, that stock had given was in 2014 when it was up 180%, and in 2015 it registered gains of almost 150%. But let's move on to our next trend of the day. It has been a smooth ride for the auto and the auto ancillaries in the last year, except for some select stocks. But what does 2018 have in store? Will this up move continue, or are there some hurdles in sight? Let's get an analyst view. Joining us on the show is Jinesh, Gandhi, Deputy Head of Research at Motilal Oswal Institutional Equities. Mr. Gandhi, good morning to you and thanks a lot for joining us today on Bloomberg Quint. How would you rate the earnings of auto ans in 2017, and also tell us what's the kind of expectations that you have for the second half of this fiscal?
So, in terms of 2018, for companies under our coverage on auto component side, we see a good traction in companies like Endurance Technologies, Bharat Forge, companies like battery names, both Amra Raja and Exide. These are the four companies where we see a clear-cut traction. In case of companies like Bosch, we could see traction depending on the CV cycle. As of now, we believe that CV industry will grow at about 5 to 7% in FY19, and based on that, we should see a good earnings growth for Bosch as well, because of normalization of margins as localization improves for BS4 components.
Some of these prominent companies have very large exposure to markets abroad and also to luxury OEMs. What's your view on these well-diversified plays?
So, with respect to companies dependent on luxury car makers globally, specific companies like Motherson, that's the only name which I can think of. I think they're very well placed from perspective of increasing content per vehicle with their OEMs, and we should see a strong traction in volumes because of new capacities starting operations, and which in turn should drive strong operating leverage and strong earnings growth. So from that perspective, we believe they're relatively better placed. Also, well, not just from FY19 perspective, but from long-term perspective, we see a company like Motherson is relatively better placed in terms of bigger global automotive trends of electrification, connected cars, so on and so forth, where they are primarily engine agnostic company. So their products become relevant, remain relevant even in electrified era. And in fact, they should see increase in content because of these larger global trends. But from short-term perspective, FY19, we should see a good traction because of new capacity starting operations and new orders as they get into execution.
What are companies like Bosch, Bharat Forge, or for that matter, Motherson Sumi, which you just highlighted, in terms of valuations, according to you, what they are factoring in? Do you think the valuations seem to be complacent now?
So definitely valuations have got re-rated in last 12 months for auto components particularly. So if you look at companies like Endurance, stock has almost doubled, more than doubled since listing. So is the case with likes of Bharat Forge, which has seen a sharp recovery as underlying business has seen recovery. However, names like Battery Packs or Bosch, these stocks have underperformed quite substantially, and there has been that has been primarily because of underlying business factors. Earnings haven't gone anywhere. So there we see some comfort in terms of valuations being comfortable in expected recovery in business, particularly for battery names. Stock like Motherson, we believe valuations are quite reasonable given very strong earnings growth. So there again, the returns which we have seen in last 12 months has been largely because of earnings growth and not any material re-rating of the stock.
You spoke about battery names, and they have had a very good run this year. But there's also been this case about volatility as far as some of these companies go, like Exide or Amara Raja Batteries. My question then is, how big a concern is this if you keep in mind the next couple of quarters?
Yeah, so you're absolutely right. The biggest risk which pertains to battery names from 12-month perspective is both from volumes more so on the industrial side, telecom and inverter. Telecom segment is where we are seeing consolidation phase right now on the telecom tower side, and our willingness to invest there is relatively low. And on top of that, we are seeing consolidation in the telecom industry itself. So number of players are reducing. So hence, as a result, we will see some pressure, continuing pressure on telecom battery demand. So clearly that is one risk and one pressure which is there. Second pressure which we see is in terms of RM cost. So lead prices have been inching up over last 3 months or so, and impact of that will be felt over next 6 months. Having said that, we expect lead prices to be passed through to customers, particularly on the auto OEMs and replacement side, and even partly on the inverters and UPS side. The only challenge we see is on the telecom and battery side. So, and I believe there will be potential offsetting factors, new drivers of growth in terms of, say, e-rickshaw batteries, opportunity in traction batteries, and maybe even solar batteries as we see continued thrust of government on renewable energy, particularly on the solar power side. So these are the areas which have not been explored yet in complete manner by any of the current battery makers, which can be fully explored over the next 12 to 18 months by these players.
Well, both Exide and Amara Raja have not given you any sort of returns in the last 12 months. But tell us, what are the key risks that the auto ancillary companies are not factoring in right now, according to you?
So the risk for these global players is largely emanating from the fact that the demand, most of these players have almost 50% of revenues coming from global markets, even higher. And a large part of this exposure is to developed markets. So any macro slowdown in these markets could be risk for these global companies with global exposure. But that, I think, is something which one has to live with when investing in such a diversified companies having both global and local exposure. That's one thing which one needs to be aware of. However, most of these companies are also actively working on diversifying their customer base in these global markets and entering with new products, new customers, which will dilute any impact of any macro slowdown. So clearly that's one mitigation strategy these companies are opting for. And over and above that, what will also help these companies is in terms of increasing content as they offer more value-added products in both global and local markets. So I think there are macro risks, but there are quite a few micro strategies which these companies are adopting to offset any macro risks in terms of what we discussed just now.
Okay, Jinesh, we leave it at that. Thanks a lot for joining us and giving us a perspective on the Indian auto ancillary space. But we'll move on to another very important sector, and that is the FMCG, sector. So the FMCG index over the last 1 year has gained around 30%. The outperformers here are Tata Global Beverages, United Spirits, Britannia, Hindustan Unilever, and of course you also have the likes of Emami and Procter & Gamble and Godrej Consumer Products, which have done reasonably well. But the real underlying trend here is that we are looking at some amount of improvement in volumes coming through over the last couple of quarters. That said, we're also looking at a little bit of volatility when it comes to margins on account of raw materials. Of course, a lot of these companies do have some exposure to crude-linked raw materials. So, we really want to get an idea of whether or not we can see an uptick in terms of volumes and what can the developing raw material costs mean for margins? For that, we are in conversation with Anand Mour of ICICI, and he's actually also written a report where he's given his outlook and perspective on the FMCG space. Anand, good morning. A happy New Year to you, and thank you for joining us. Your report does suggest that you are starting to see some amount of revival in the rural sector, which can turn out to be a big positive for the FMCG companies. That said, in the list of the companies that you have coverage on, there are still only a handful on which you have a buy recommendation, with largely neutral to perhaps some which even have a sell. Can you take us through the idea behind the rural recovery and what you have seen and the observations that you have made?
Well, rural recovery, at least the green share is clearly being talked about. That visibility of the same is there. You would have heard managements talking about it. If you were to look at on the ground, interaction with the trade ecosystem clearly suggests that recovery pickup in demand is visible. But at the same time, when you look at the valuations, I think that those are clearly factoring in all these upsides. Right now, the real question for an investor in FMCG stocks is what is being priced in and what can derail the rally in FMCG, and what can be the risk for the growth momentum for the FMCG companies from here.
Right. Anand, among your top buys, I don't see HUL. Definitely the valuations of this company are on the higher side. But if one has to look at the returns for the last calendar year, the stock's given good returns. It's one of those, defensive play which also benefits from the rural demand revival that majority of the managements have been highlighting post their second quarter earnings. And going into the earnings season, once again, the low base is going to work in their favor. What's the call on HUL?
We have a reduced rating on HUL. I just like to say, when I say what can go wrong in FMCG, well, if you were to look at the FMCG companies right now, all of them are sitting on a very high operating margins. If you were to look at, the rural demand revival which is being talked about, and also the low base of FY18, clearly spells that this is an opportunity for FMCG companies to garner higher market share. I'm raising a question, shouldn't FMCG companies right now, is it intuitive that FMCG companies will be looking at opportunities where they can correct the value proposition and go for high market share? In FMCG companies, normally it's the consumer acquisition becomes important, margins to come in the interim. And that's what I see, that after 3-4 years of lull growth, if there is an opportunity for growth coming in, should FMCG companies strive for some kind of value proposition correction in certain categories and go for a high market share? I think that's something which we are going to see during the course of next year, and that's what makes me believe that the current valuation is not factoring those kind of hypotheses. Let's see how the how Q1 FY19 evolves around the competitive intensity.
Okay, so Anand, in that case, will the gain in market share come in lieu of giving up some of the pricing? In that case, can we see a weaker pricing environment when it comes to a lot of these companies?
Sorry, I didn't get your question.
No, my question is that if you're suggesting that we could see a trend of for some of these companies to go ahead and try and get more market share, in that case, can this be against, a relatively lax pricing environment? In that case, is it a possibility that we may not see as many price hikes coming in as we move into the next couple of quarters?
So that's just a possibility. What I am saying is all the good things are being factored in the current price. What can go wrong is the price competitive aggression, which may start around after Q1 FY19. Primarily, I don't think next 3-4 months, or it's something where we should see all these aggressive price action, because companies will like distributors to settle down with the GST changes. So e-way bill comes in Feb, those kind of adjustments need to be settled down, and that's what companies are not going to change lots of value proposition prior to that. What can go right is also another question, is maybe the rural and urban growth revival happens significantly, premiumization trend comes in, we are going to see the best of the worlds for FMCG companies. But that's what I'm saying, if that's what the report says, that's being factored in the current valuation. If we are to see that those kind of trends are going to be there for the next 3-4 years, clearly some of the companies offer even a good opportunity from this level. My buy includes Colgate, and I believe that oral care is a category where we have seen those kind of actions over the last 3 years, and the correction is happening to be visible over the next 2-3 years, and that's where Colgate is going to be the beneficiary.
But does it not worry you with the kind of competition Patanjali is giving to Colgate, Anand?
Well, that's exactly that. Last 3 years, competition has been pretty severe for Colgate. Colgate has taken the corrective action. They have entered their presence in the Ayurvedic space, in the natural space, and my channel check suggests that they have been able to garner good traction with the consumers, and so it's whatever the corrective step Colgate is taking surely should help Colgate to regain the market share they have lost in the last 2 years.
Okay, so you also have a preference towards Manpasand beverages and Godrej consumers. What are the opportunities here? And if you could also tell us about the possible risks for both these companies on which you have a buy.
Yeah, Manpasand Beverages is clearly a growth company. The company, why we like the company is essentially the company is expanding both the capacity as well as the distribution. On capacity front, they raised the QIP about some time back, and expected capacity is going to go streamline somewhere from the end of this fiscal year. At the same time, they have also did some tie-up with Parle products, and clearly that gives them an advantage to increase the direct reach what Parle products have. So, I mean, it's something which Manpasand overnight get a much higher direct reach to the consumers. So both these elements should clearly enable Manpasand to post about 50% earning CAGR over the next 2-3 years. In my understanding, this is clearly a high growth stock and offers much high upside from current levels, and that's the reason it is one of the top pick for us. Similarly, Godrej Consumer, again, that's one company which again should be beneficiary of the growth revival, and at the same time I don't see much competition impacting them in their offerings in the market. At the same time, last 3 years, if one were to look at, while the market was not showing higher growth, but Godrej Consumer has invested a lot in the distribution and the portfolio, and clearly if we are seeing a medium-term revival happening, then Godrej Consumer shall benefit over the medium term. And that's the reason why we like that company. In terms of risk, clearly for Manpasand, the risk is going to be more about the Parle product tie-up which they have, is if that doesn't play out the way the company has talked about in the quarterly conference calls. If the national rollout of the tie-up doesn't happen, that should be the key risk in case of Manpasand, because that is the real push up to the growth momentum which this company can achieve. In GCPL, again, if the price competition happens in their categories, I will be wary of their valuation.
All right, Anand, we'll leave it at that note. Thanks a lot for joining us today and giving us your views on the FMCG space. Well, that's it that we have on this edition of Trend Spotting. Thanks a lot for watching the show.
Lots more lined up, so stay tuned to Bloomberg Quint. Up next is Hot Money with Darshan Mehta.